Hello all the participants. I welcome you all to the ACCA Financial Management Practice to Pass sessions. Today is day 5. Today is our last day. And today's topics are going to be some questions we'll be doing on risk management and some risk management concepts. And then we'll be moving on to the business valuation concepts and questions. Okay. So I say thanks to ACCA on providing us this tremendous opportunity of learning together through this platform. So thanks again to ACCA. Okay, so let's start with the risk management work that we started yesterday, and we did set a money market hedge in case of receiving foreign currency in 3 months time. So today we will learn how to set a hedge if you have to make a foreign currency payment in future, and we will revise the strategy for receipts as well. So the next question is Mallet Company, question number 2, which is appearing on your screen right now. So participants, I request you to please go through it. Please go to the question. I'm giving you around 3 minutes to read the question, and then we will start with this question. Let me tell you, the first requirement is about what cash in the local currency will the company collect if they set a money market hedge. So it's a revision of the last day's question, last day's work as well. Ji walaikum assalam, Temur. Okay, so the first step of the strategy was that we will borrow foreign currency now. How much we will borrow? The present value of the currency to be received. So first we will calculate the present value of the currency to be received. So $850,000 are to be received in some time, and we will divide this or multiply this by 1 plus r to the power minus n, or divide by 1 plus r to the power n. So first we have to calculate the rate at which we have borrowed. So it is we have borrowed the money for 3 months because the currency is going to be received in 3 months time. So we'll calculate the present value for 3 months time, right? So in order to do this, first we will calculate the rate of borrowing, means RB. RB is over here 3.3%, 0.033. This is annual rate. We have to convert it into 3 months time. So converting it into 3 months time, this gives you 0.00825, and then we will calculate 1 plus RB. So 1 plus RB is equal to, so dividing 850,000 by 1.00825, this gives you the foreign currency amount to be borrowed now, which will be 843,045. Now this foreign currency amount which we have borrowed, we will convert it immediately into the local currency at the spot rate, and they have given you the spot rate as 0.7233. So in order to convert it, 843,045 shall be divided by 0.7233. This gives us the local currency amount, which is 1165554, 11,65,554. And now we will invest this amount, this local currency amount, for 3 months, so that we can have a compensation of interest to be paid on the foreign currency borrowing with the local currency interest income. So we'll invest it or lend it. So on lending this amount, in the second step, we will receive after 3 months time the principal and the interest amount, which will be our predetermined cash receipts after 3 months time due to the money market hedge. So this is what has been fixed, and now we are not exposed to any cash flow changes due to the spot rate change, because it is now through money market fixed that how much amount will be receiving. So in this case, we will be taking the lending rate. We'll be taking RL, rate of lending. So the lending rate given in the question is 2.9%. So again, this is for the year. You will convert it into 3 months, and then we'll calculate 1 plus RL. So 1 plus RL becomes 1.00725. So this gives you the local currency amount that the company will receive, 11,74,004. So these were the steps for hedging foreign currency receipts through money market hedge. Yes, good afternoon. Thank you for the greetings. Okay, students, now moving on to the part B. Which of the following relationships suggest that current long-term interest rates can be used to predict future short-term interest rates. So which of the relations can be used to predict the short-term future rates? So it is expectancy theory which helps you out. The long-term interest rates give you an indication in advance. Like for example, the long-term interest rates are increasing. What do this indicate? That a 5-year borrowing, suppose, is for 10%, and an 8-year borrowing is for 9%, and a 10-year borrowing is for 10%. So as the borrowing extends and it gets longer and longer, the interest rates are rising. This indicates that in future the interest rates are going to increase. From these agreements we can judge. So now, as we know that they are going to increase in future, and currently the agreements have been undertaken, so now we can predict that the interest rate is going to increase in the future for short term as well, right? Because of these agreements. So this is expectancy theory. So we, on the basis of judgment expectations, we made this assumption. Okay. So the next point is, what is the 3-month forward exchange rate to 4 decimal places? So now they have not given you any forward exchange rate in the question, right? They have given you just a spot rate in the question, which is 0.7227233. Now a forward rate can be judged. Forward exchange rate, if you remember, which we use in hedging, the bank, if you enter a bank, you may see a screen over there which may be showing a spot rate, which means that this is the rate at which you can buy the currency today, immediately. And then you may get a 1-month forward rate, 3-month forward rate, to which people enter into in order to save themselves from foreign currency movements in the future. They enter into that agreement, forwarded agreements, in advance. This was a forward contract, as we discussed in the previous class. So we have to calculate a forward rate over here, and forward rate can be calculated using interest rate parity theorem. There is an interest rate parity theory formula which we can use to calculate the forward rate. Let me share the formula with you. So that's the formula on your screen for interest rate parity theorem. So using interest rate parity theory, forward exchange rate is spot rate multiplied by we'll multiply the spot rate by 1 plus interest rate of the foreign currency. So in the numerator, you will take interest rate of foreign currency, and in denominator 1 plus interest rate in local currency, right? Now this is similar to our spot rate. Our spot rate is written like this. In this question, the spot rate is 0.7233, and this 0.7233 is the rate of the Australian dollars, AUD, right? So the interest rate of the Australian dollar will be appearing as it is appearing over here. Okay, so this is the way how we judge. So now we'll put in the figures to arrive at the forward rate. using the interest rate parity theorem. So remember, we can estimate a forward rate using the interest rate parity theorem. So in a question to hedge by a forward contract, a forward contract rate is absent. So in that case, the question will give you the interest rates of the foreign currency and the local currency. So use those interest rates to calculate the forward rate first, and then convert the foreign currency amount into the local currency, which will occur in the future. Okay, the foreign currency over here in this question is US dollars. Okay, let me calculate the foreign exchange rate over here. So first I will be taking the spot rate, which is 0.7233. I will multiply it by 1 plus we have to convert over here also 0.033 is the interest rate for a year, and we have to convert it into 3 months, as the transaction will occur in 3 months time. So we have to convert it into 3 months first. So this gives you a 3-month interest rate, and then we have to convert the 2.9% interest rate, which is of the Australian dollar. This also needs to be converted into 3 months. Okay, so now putting it into the formula, 1.00 divided by 1 plus 0.00725. So this gives you the forward rate. The forward currency rate is 0.724 according to the interest rate parity theorem. Right. Okay, correct answer has been received from Deepa in my chat box. Good. Okay. Now moving on to the next question. Now you have to remember this formula. Okay, next. One risk, let's move on to the part D. One risk that a company which exports and imports may face is that of exchange losses when accounting results of its foreign branches or subsidiaries are converted into home country. Yesterday I explained to you this. This is known as a translation risk. Translation risks do not result in any losses in actual, it is just in financial statements. This is basically used in consolidation of foreign currency transactions into local currency. So the answer to this part is D. D is the correct answer. It is known as translation difference. Okay, translation risk. Then part E. Why is a currency option a particularly suitable device to reduce exposure to currency movements when tendering for a contract priced in a foreign currency? Now, what is a tendering? Tendering is basically a process through which we will try to obtain or to win a contract. So we have not yet entered into a contract, right? Now remember that if we enter into a forward contract of currency, it's a binding contract. Once we enter into it, we have to follow it, and we then have to buy the foreign currency in the future. Over here it says, the question says that the company has not yet entered into a foreign currency, into a contract which is priced in foreign currency. So can we enter into a forward contract for receipts? We cannot, because we are uncertain as to whether we will be entered into a contract or not, and whether the foreign currency will be received or not, right? So if we enter into a foreign currency option, in an option we have a 50-50. We have a choice that if you need, you can exercise the option and you can convert the foreign currency into the local currency. Otherwise you can let the option lapsed. If you don't want foreign currency, leave it. Doesn't matter. You won't be penalized for it. So it's not a binding contract. So in this case, the best option is D. You may not get the contract and therefore the currency. So the currency option is the best suitable option over here, over where we can easily uh, get an exit from the contract even if we do not enter into this foreign this we do not get successful in this tendering process. So we have an exit option also. So the correct answer to this part E is D. Okay, remember, foreign currency option is the most expensive uh, hedging instrument, because it it brings the foreign currency option writer into a big risk, right? So he will be charging a very high price for it. So it's not cheap. It is always an expensive option compared to any other options. Yeah, I've explained point A. Then point B is least risky means of achieving a hedge. So it's not relevant to this situation, right? Obviously, the risks are vary according to the negotiation. So we don't know the negotiations over here. So obviously, this cannot be the most suitable one. So over what's the question asking? Why is a currency option a particularly suitable device? So in this situation, they are asking about that what could be the most suitable one, right? So I've given you the most suitable answer over here. So that was important. The word was important there. Okay. Now the next question is noon. Okay. Okay. Please go through this question. I am giving you around 3 minutes time to read this question out. Then I'll be solving it out. And in this question, we will be setting a strategy to set money market hedge for foreign currency payments. Once we get finished with this risk management portion, we will be discussing some study tips and then moving on to the business valuation portion. But we have some work to do first. In the money market hedge for receipts, remember one thing, that in the first step, we borrowed foreign currency and then converted that foreign currency into the local currency and then invested them. And we received money after 3 months from the investment amount along with the interest. In case of money market hedge for payments, remember, we will first invest the foreign currency amount. Okay. So in case of borrowing, what happens that we will receive foreign currency in future. So instead of receiving in future, we have to receive now. So we borrow. In case of payments, we have to make the payment in future. So we will try to pay it now. Now, how can you pay in the money market? By investment. If you invest money, you pay the money out to the bank, or you invest somewhere, the cash goes out immediately. So this happens in the payment section. So we will see the 3 steps over there in the next part. Let's first do the part A. So in part A, what is the cost in the center land colons of a forward market hedge? So a forward market hedge is to be used over here, and as per question, there is a local, there is a foreign currency payment to occur over here. So forward market hedge to secure a foreign currency payment is required. So in this case, the rate that will be used, the foreign currency rate, forward rate will be used, the lower one. Why the lower rate? The lower rate because we will carry local currency to the foreign currency dealer, and at his counter he will receive local currency from you. Means you will be buying the local currency from you. He will buy at a lower rate, right? So that's why we will be exchanging at a lower rate. So the lower rate in this case, the 3-month forward rate will be used, which is 6.321. So 6.321 is the lower rate in this case. So you can learn like this also. In case of foreign currency receipt, you will be using the higher rate, HR, H for the higher rate and R for the receipts, right? So but just remember that HR, and otherwise it should be the lower rate in case of payment. So the amount will be calculated as follows. The foreign currency to be received is 3 million flyland francs. This should be divided by 6.321. This gives you the center land colons, which is equal to 474,608. So the correct answer is option B. Okay, next. So this requirement B, you know now. I have recently explained you the requirement B above in a question. So what would be your answer to this question B? Yes, Idrissa gives the correct answer. Purchasing power parity theorem is used in predicting the future spot rate, not the forward rate. They are talking about the forward rate. The question says, which of the following relationships attempt to explain the difference between the forward and the spot rates of exchange between two currencies and the relative rates of interest in the countries of origin of the two currencies. So it's interest rate parity theorem, which uh, tells you the difference between the spot rate and the forward rate. In case of purchasing power parity theorem, it tells you the current spot rate and the future spot rates difference. So there's a difference between these two. Okay. So two of the people gave correct answer in the chat box. So good participation. Thank you for participation as well. So the correct answer is C. Okay. Now moving on to the part C, which is an important one. What is the cost in central and colons of a money market hedge? So in case of payment, we are exposed to a risk that the foreign currency strengthens, and we may have to make a larger payment than the current spot rate in 3 months time. So in order to secure this exposure, we will set a money market hedge. So let's set a money market hedge first. So as I said, in case of money market hedge, what will you do first? You will lend the foreign currency. Now, how much foreign currency will be lent? Present value of the actual amount that will be paid, right? So first we will calculate the present value of the actual amount will be paid. Okay, so let me write the steps as well for you to follow afterwards as well. So now I am preparing a money market hedge for foreign currency payment. So step one for the money market hedges, invest foreign currency now. For this, we will calculate present value of the foreign currency payment, and the formula for this is foreign currency payment divided by 1 plus rate of lending. Over here we are lending money, so we'll be taking the lending rate. And in what currencies rate? The foreign currencies rate, because we are lending in foreign currency, so we'll be taking the rate also in the foreign currency. So keep the action in view that if you are borrowing, take the borrowing rate. If you're borrowing foreign currency, take the foreign currency rate. If you're borrowing local currency, take the local currency rate. So it's present there. Okay, so we'll divide it. Now the transaction occurs in 3 months time, so you have to convert the rate per annum to the 3 months rate. So let me convert the rate first. Zero 0.135 into 3 divided by 12, and then 1 plus RL. This makes 1.03375. Okay. Now the foreign currency payment amount is 3 million. Divide by 1.03375. This gives you the present value of the foreign currency payment, which is 2902056. Now this is in francs, flyland francs. Now the next question is that how you will invest this amount. In order to invest this amount, yes, purchasing power theory is basically based on inflation. So the correct answer in the part B was interest rate parity, because interest rate parity formula includes and it converts spot rate into forward rate. So it's a relationship between forward rate and the spot rate. Purchasing power parity theorem is a relationship between the current spot rate and the future spot rate, not forward rate. It is a relationship between the current and future spot rates and based on inflation. It is due to inflation that the spot rates change. And it's due to interest rate that the forward rate is different from the spot rate. Okay. Now how you will get this 2,090,205 francs? So for this, need to first convert the local currency into foreign currency. So we will convert the local currency amount in order to buy the foreign currency. So what should be the rate? You will be using the lower spot rate because you have to pay the foreign currency. So you have to buy the local currency. The foreign currency dealer will buy the local currency from you. So using the lower rate, you will convert it. So I'm writing the formula over here. The foreign currency amount to be invested divided by the spot rate, lower rate. It will always be a lower rate in this step. Okay. So dividing 2,902,056 by the spot rate, which is 6.170, the lower spot rate. This gives you the amount of local currency which you will need to buy the foreign currency, which is the foreign currency colons equal to 470349. Okay, now this amount 470349, the local currency amount, will have to be borrowed. We will borrow it and then convert it into the foreign currency and then invest it into the bank account. Okay, so now the next step is borrow. In fact, we would first have borrowed, then converted into the local currency, and then would have invested. But remember, you are going to do the steps in this sequence only to arrive at the answer, because the third step will give you the basically amount that you will be paying in 3 months time. So this amount which is borrowed in the local currency will be paid after 3 months time along with the interest to the creditor. So that will become your local currency payment after 3 months. Right? So what the question is asking, that what is the cost? The cost means the amount that you will be paying after 3 months. So after 3 months, you will be returning the borrowed amount. So this is the last step is the calculation of return the borrowed amount used to invest in foreign currency along with interest in 3 months time. Okay, so now in 3 months time, how much amount will be repaid? So it will be amount of borrowing multiplied by 1 plus what rate should it be? RB, the borrowing rate. And in which currency? As you have borrowed the local currency, so it should be the local currency amount. Okay, so now let me calculate RB first. So pick the borrowing rate. Borrowing rate is 8.1% per annum. So I have to convert it into 3 months rate, and then 1 plus RB. So 1 plus RB becomes 1.02275. Now let me link the amounts to make it easier for you. So the step 1 amount is plugged into the step 2, and then the step 2 amount is plugged into the step 3. So the amount in the local currency that you will have to pay, the redemption amount of this borrowing, and the principal, in the interest amount. So this will make 479,874 central land colons. So this is your answer. Now what happens to the invested amount? The investment amount of 2,990,256. After 3 months time, interest will be included in it, and the amount will become 3 million. And at that time, you will have to make the foreign currency payment. So as you invested in the foreign currency, the amount will be returned after 3 months also in foreign currency, and that 3 million amount will be given to your supplier who is asking you for payment in the foreign currency. So in this manner, your future local currency amount gets fixed and your foreign currency amount gets paid through that redemption of that investment. Okay, there's a question from Adolfo that why we are using the lower rate. We are using the lower rate because that, look, you have the local currency amount in your hands, right? You will take it to the foreign currency dealer and place it on his shelf, on his counter, right? So what he will be doing, he will be receiving local currency from you. So he's buying. So the buyer receives local currency, and the foreign currency dealer, always remember, will deal in the local currency, and he's telling you the local currency's rate in this question, right? So he's buying. So he will be buying at a lower rate and selling at a higher rate in order to make the profit, right? See, it's very simple, Omar, very simple. When you are paying foreign currency, use the lower rate, right? When you are involved in payment, use the lower rate, right? So in this case, we were paying. I was using a lower rate. So learn the mnemonic like this. Suppose PL. So PL will become foreign currency payment. Use lower rate. Whether it's a forward contract, whether it's a spot rate, whether it's a money market hedge, everywhere use the lower rate. And in case of a receipt, RH, right? So in case of receipt, use a higher rate. So make a mnemonic PL RH. So this becomes a mnemonic for you. Okay, now is it easy now? This is in the case that they have the dealer quotes you the rate for the local currency, right? In that case, we'll be doing like this. This is basically an indirect quote. So they will usually be giving you an indirect quote only. So don't worry. usually in the international market, always the indirect quote is used. It's only in countries like Pakistan and all they use a direct quote, right? Pakistan, India, and this type. Otherwise, in other countries they are using always in Middle East and US, UK, they are using indirect quotes. They tell the rate of their own currency, right? Yeah, if you have any questions, you can ask me individually also, because on the if you send a question on the group, it sometimes becomes a problem for me because I get difficulty in tracking that to whom you are asking, and a lot of chat is going on, so I'm not being able to keep track of all the items because I have to do some other work also. So obviously from the group you have my number, so you can ask directly over there. I'll answer you. Okay. That's about after workshop. If you have any question. Okay. So that's the answer to this question. Now let's move on to the part D. Now in case of part D, the question says indicate. Now it's a request that please learn this strategy. They do ask money market hedge in the exam. So at least you are going to be tested for 2 to 5 marks on the money market hedge, right? So do learn the strategy which I have given you. So it's a 3-step strategy in the receipt also, and a 3-step strategy in the payment as well. So let me shade these 3 steps. The golden step, then the second step was let me shade it in green, and the third step is shaded in blue. So these are the 3 steps. Okay, now moving on to the part D. Indicate by clicking in the relevant boxes whether the following statements on the characteristics of interest rate futures. So there is a futures market situated in London, for example, and interest rate futures are being sold there. So interest rate future is just like a share certificate. So as the share certificate are standardized, and suppose $1 is written on it as a face value, right? And on currency notes we write standard figures, and some in some countries the shares may be of 10 rupees or 100 rupees, and all shares will be of the equal price of 10 rupees only, right? So these are known as standardized items. The contracts on which the prices are quoted in advance and it remains same on all contracts, so it's known as standardized. So it is true that interest rate futures that are being traded are all standardized contracts. So amounts and periods are standardized, right? So periods are also it will be either a 3-month interest rate contract fixed for a fixed period. They are legally binding contracts, yes. They are binding contracts, but it's only option which is not binding. You have choice in option, otherwise all are binding contracts. Then they can be bought and sold on secondary market. Yes, future market is itself a secondary market. It is just like stock market where you can sell your contracts to other parties when you and you buy it also from there and sell also there. So on a secondary market. Okay. Then they can be used both to hedge risk and speculate. Yes, obviously interest rate futures can be used to hedge the interest rate increase in case of borrowing and interest rate decrease in case of investments. It can be used, and it can also be used to speculate. Obviously this is a derivative, so you can use to speculate and earn differences, earn through differences. So all of these are true. Then now part E. One of our friend was asking about purchasing power parity. So in this question, the purchasing power parity will apply. See what is it asking? If inflation is currently running at 3.8% in Central Land, what is the implied inflation rate in Flyland? So you have to calculate the inflation rate. And how will you calculate the inflation rate? That you know the spot rates. spot rate now and the future rate as well. So through this, you can calculate the inflation rate. Interest rate parity theorem involves interest rate. Over here, it is inflation rate. So let me show you the formula for the this purchasing power parity theorem. The formula is future spot rate is equal to spot rate now. So these two items over here are inflation in foreign currency and inflation rate in local currency is in denominator. In the above formula for interest rate parity theorem, the formula included interest rates on which the forward rate was based. Okay, now plugging in the figures over here, we will get the inflation rate. So let me put in the figures. So we do have the future rate. Instead of future rate, we will be using the forward rate, as we do not have a future rate in this question. So we'll use the forward rate 6.321 is equal to the spot rate. The spot rate was 6.107. Then 1 plus. Now, which inflation rate do we want? This inflation rate we want is in Flyland. So it's foreign currency. Flyland is a foreign currency. The company is itself situated in Centerland. So inflation of foreign currency is required divided by 1 plus inflation in local currency. So now putting in the figures, I can put the figure in the denominator as well. The inflation in the local currency has been mentioned in the requirement E, which is 3.8%. But 3.8% will have to be converted into 3 months time. So that's why I'm dividing by 4. Right? So the 3.8% is for 12 months. So if I divide by 4, it will get into 3 months time. Otherwise, you can multiply it 0.038 into 3 divided by 12. So we'll get the same one. So the inflation rate over here, by solving the equation, you will get, by solving this equation, you will get the inflation rate in the foreign currency, which is equal to 0.1368. And they say be in the nearest percentage. It will become the accurate rate is 13.68, and in the exact percentage it is 14%. So the correct answer is 14% in this case. Okay. if two spot rates are given, one will be the current rate and one will be the future rate. So spot rate to be used on the right hand side is the current spot rate, and to be used on the left hand side is the future spot rate or the forward rate, right? Okay, participants, the spot rate is 6.17. Okay, now moving on to the next question. Hedge company, a large manufacturer. Please read this question. Now this question is based on the interest rate things. Okay. So requirement A, which two of the following are possible reasons? So you have to select the best two. You have to select the best two items. So what two will be the best? The best reasons are B. Why B? What do Modigliani and Miller say? They tell about the tax shield. So according to Modigliani and Miller, what happens that according to the Modigliani and Miller, if the company borrows funds, the company will pay interest, and it can deduct that interest from taxable income and save some tax. So due to the saving of that tax, your borrowing cost is decreased. The borrowing cost becomes, instead of 10%, if you remember, we multiply interest with 1 minus t. So 1 minus t, it becomes, if it's 30% tax rate, so we multiply 10 by 0.7, it gets 7%. So the cost of debt goes down. So the main reason over here, they are concerned about the cost. So if they are concerned about the cost, which look like in this thing, that they are concerned about the yield curves, So yield curves, by yield curve we see that how the interest rate will move in the future, and they want to save some losses or cost arising in the future. So one of the correct ones are B and the D. The servicing cost means the interest expense itself. Interest expense is the service cost of borrowing, servicing expense. So the servicing cost of the debt will be lower. Equity is obviously expensive. So these are the two which can be taken as the best. Otherwise, others can also be taken, but they are not the best ones. The main item should be these items, the cost according to in the context of the question. So the correct is B and D. Next, which of the following not be a possible explanation for the normal yield curve? Achha, what do we mean by a normal yield curve? Normal yield curve means okay, the yield curve will be a rising curve. No, C is not the answer, because they are not interested in C, and they are talking about in saving the interest expense. This is about issue cost. So in nowhere in the question they have talked about issue cost or security. That's why I have not taken the issue cost and security into consideration. But Modigliani Miller theory directly impacts the interest cost, the tax shield. So I have picked both portions which are affecting the cost. Okay. No, Modigliani and Miller theory is not mentioned over there, but we should know that Modigliani and Miller theory involves something about cost of debt, right? So it's the main theory about cost of debt due to which one of the reasons for the lower cost of debt is that it is less risky, right? As I discussed earlier in the last class. Second reason is cost of debt. The second reason is tax shield, right? These are the two reasons because of which the cost of debt is lower. So these two items B and D belong to the cost of debt in this manner. Okay, Temur, is it okay now? Okay, now what is a normal yield curve? Normal yield curve shows that the interest rate for longer term borrowings are rising, and it will be a rising curve like this. It is drawn like this. Okay, please give me a while to pick the pen. It is drawn like this. On the y-axis, it's a percentage, and on x-axis, it's time, the borrowing time, 2 years, 3 years, 4 years, like this. So if it is going up, means that the interest rate is going to increase. And inverse, if the curve is inverse, then it will be of this shape. It will be like this. This is the inverse curve. So this means that interest rate are going to fall in future. Reverse. And this indicates that interest rate are going to increase in future. So which theories do this link to? So for this you have to read the theories in future. So they are asking about that which of the following would not be a possible theory. So expectation theory do show that interest rate are rising in future. Liquidity preference theory do show that why do people prefer cash, that people prefer keeping cash. That's why you in the future, in order to borrow or invest for a longer time, the bank has to pay a higher rate of interest in the future. So the longer the borrowing, the longer will be the rate. This is the liquidity preference theory. So the interest rate and the yield curve is moving upwards, increasing. So liquidity preference theory also says that people intend to hold cash, but if you want to take cash from them, you have to pay a higher rate, and for more time, if you want to hold cash from them or obtain deposits for a longer time, so even more interest rates are to be paid. So this is also covered in that. Okay, and then an expected rise in interest rates. This is also been observed in the normal yield curve, but market segmentation theory is not covered over here. This is not suitable. The short term and the longer term markets basically are involved in the market segmentation theory. It is dependent on whether there is a higher demand for short term or long term. It depends on that. Okay, so the correct answer for this is, for this you have to once at least go through these theories, at least read these theories. Okay, students, let's move ahead. The next one. So next one is now forward rate agreement. FRA. FRA stands for forward rate agreement. It is related to interest rates. Let me explain you a bit about this. In the forward rate agreement, select from the top down list which represent the payment receipt payable on the FRA if the reference interest rate moves to 7.6%. Okay, now what they want to ask, let me refer to the main question first. Look, in the main question, there is a terminology. This 3v9. What do this mean? What do this 3v9 means? This 3v9 means that the company wants a loan after 3 months and for 6 months. So the difference between 3 and 9, take the difference between 3 and 9 is 6. So loan is required for 6 months, right? And 3 represents the first digit. 3 represents that loan is needed in 3 months. After 3 months, loan is needed, and there is a risk that the interest rate on the loans will increase. This is what the problem. So this is being talked about in the second paragraph, that they are concerned that if the rate after 3 months of loans increase, what happens then? So they enter into a forward rate agreement. Now, remember, the bank will, if you go to a bank, right? So the higher rate quoted by them will be your borrowing rate. Because if you go to bank and make an investment over there, the bank will pay you a lesser interest rate. And if you ask them to borrow, I want to borrow funds, they will give you at a higher rate because they earn a margin. They give you a loan at a higher rate and they take money from you at a lower rate. And there is a difference in the both rates, the lower and the higher rates. So they earn money. So the rate for your borrowing will be higher. So over here they are borrowing. So what rate should be taken? 7.8%. And the lower rate will be for deposit. So if you deposit your money in your bank, the bank will offer you a lower rate. But if you ask them to lend money, if you ask them that I want to borrow, they will give you a higher rate. So 7.8 is the rate. So this is the guaranteed rate. This is the guarantee sort of thing. that if you enter into a forward rate agreement, the bank give you a guarantee that if the rate exceeds 7.8, they will pay the extra interest. So if you are exposed to an interest rate in 3 months time and the rate given is 7.8, so any rate in excess of 7.8 will be uh, paid by the bank with which you enter into the agreement. And but there is a very important thing: if the rate remains lower than 7.8, then you will have to pay the difference. So if the rate is 7.5, you will have to pay the bank against this agreement, right? So if the rate exceeds the rate in case of borrowing, you incur a loss. Bank will compensate you. They will make you a payment. But if it is lower, then you will have to compensate the bank, right? This is in case of borrowing. But in case of investment, it will be reverse. In case of investment, if the rate remains low, you will incur a loss. So bank will compensate you. They will give you money. And if it exceeds the rate, then you are earning more. So you will have to pay the differential to the bank. It works like this on differential basis. So now what they are asking in this question is, let's see. Uh, in this case, the rate is 7.6, which means that the actual rate after 3 months time is 7.6, and the FRA is asking for 7.8%, right? So FRA's rate is higher and you get at a lower rate. So you have to make a payment 0.2%. You will have to pay. Bank will not pay you because the rate has remained below the guaranteed amount by them. So the amount to be paid will be 0.2% multiplied by 10 million multiplied by 6 divided by 12, because the borrowing was for 6 months. So the cost will be for 6 months. 3v9 means the borrowing was for 6 months. So the answer is 10,000. So there should be a 10,000 payment. Okay. Now part D. Positive yield curve occurs when the interest rate are rising. बताइए बा? When will the positive yield curve occur? When on borrowing longer for a longer time, the interest rate is rising. You are asking about B, na? So D is correct. They are asking which one is not correct. Okay. So moving on to the part D. Which three of the following are reasons why futures are not always a perfect hedge? Now, Why futures are not a perfect hedge? So one of the reasons is that the futures are of standard size, and your transaction may not be of the same size. So due to the difference, all of your amount may not be hedged. One of the reasons can be this. The second reason could be that the future dates are fixed. The futures are bought and sold at exact dates, but suppose the dates are first of a month, first of suppose April and then first of July, and your transaction is going to occur on 16th. The dates will not match. So for 16 days you won't be able to hedge. So it won't be a perfect hedge. For 16 days you are exposed to the changes. And third, it is due to the basis risk. There's a basis risk as well. Basis risk means that the the hedge the hedged amount, suppose it results in a loss of 3 lakh, then you need a compensation of 3 lakh. But you don't get a compensation of 3 lakh through the hedge, you just get a compensation of 2 lakh. So that this difference that you are not exactly compensated is known as a basis risk. So A, B, and C, all of the three are correct. And D say that interest rate are hard to predict. So it's a fact. That's not connected to this is not a feature connected to futures. This is a feature connected to all items and any contract that may exist. So ABC is the correct answer. The three of the correct answers are A, B, and C. So first three are actually the features. Okay, then the last part. Which of the following statements concerning FRAs and interest rate futures are true? This is regarding both FRAs and interest rate are true. So in both cases, company H still needs to borrow the money at the market rate in the 3 months time. So only in case of okay, let me explain you first. In case of forward rate agreement, the bank with which you enter into a forward agreement will compensate you for anything in excess of 7.8%, right? This means that you have to enter into a loan agreement with some other bank. So with one bank you will be entering into a loan agreement, and with other bank you will be entering into a forward rate agreement, right? The same thing is in future contract. There is a future market where we buy a future or sell a future and then close it afterwards, and we enter into or earn a gain or loss, right? And this gain or loss compensates you for the loss that occurs in the actual transaction, means in the actual borrowing or investing. So the amount of loss that occurs in the actual transaction is being compensated by the future contract in the future market. So the first point is correct for both cases, FRAs also and the futures also, that H will have to borrow in the spot market and it will get compensation from some other bank or some futures market. So compensation is received from some other party and the loan is received from some other party. That's very correct. Then both have standardized contract size. So there is a standardized contract size for future contract, but not for FRA. FRA is negotiated with the bank. So if you need a loan, then go to another bank and get an if you need a loan in future and you're exposed to interest rate increase, so go to the other bank and get the amount negotiated. It's not of a fixed size, so it depends on how much you are going to borrow. So it's not of a standard size, tailor made. That's why this do not apply to FIs. So second one is not true for both. Okay, both result in a net gain or loss that can be offset against the loss or gain on the associated real world borrowing. So that's correct. So the gain we earn in the share market or in the difference we receive from the forward rate agreement will compensate us for the real borrowing, right? So this is also correct. So 1 and 3 are correct. So the correct answer is C. Okay. So participants, let's move on to the next question. Peony company. Okay, please go through it. This is our last question for the risk management. Now we'll move on to the business valuation and the tip section. Okay, please read this question. Now the 26 is an easy one. Why do kink appear in a normal yield curve? So it is simply due to the market segmentation, the short-term market of borrowing and the long-term market of borrowing. So the correct answer to this is C. A, B, D, and A and D are just not they are senseless, and B is not correct. Normal yield curve means, see, this is a normal yield curve, which I showed you a few minutes ago. This is a normal yield curve. Now on y-axis there are percentages of interest, right? And over here there is borrowing time. So yield curve shows you, suppose if you are borrowing for 2 years, so this is the interest rate, right? If you are borrowing for 4 years, the interest rate rise, it jumps up to this much. Then if you borrow much more longer, the interest rate is rising. So it shows you longer you borrow, the higher will be the interest rate. This is the shape of the normal yield curve. Is it okay? Students, see, one thing I tell you, I'll be giving you some study tips as well right now, that you do have a lot of time before you enter into your exam. So the deficiency, first judge your deficiency, that what are the areas where you are deficient right now. So sit for an hour and identify your deficiencies, that what theories you have not read at all, right? Or what are the theories where you are struggling, and what theories you are strong at. So the areas where you are strong at, please keep them aside for some time and go through and invest some more time right now into the areas where you are weak, like risk management, like factors, like some areas in the business valuations, the theoretical areas in business valuations, right? These types of things you need to do at this time. First just you need to know and judge that in what areas you have done nothing, or you are doubtful or uncertain in it. So in order to get certain, you have to read it properly. So do it right now. Okay, then apart from this, see, if you keep learning those things which you are very good at right now, you're wasting your time, because you know that you are accurate over it. So no need to invest extra time on it. Like for example, calculating NPVs, you are good. Suppose you are good at calculating ratios, so no need to invest unnecessary time in it. If you are good at calculating cost of capital, and you have uh, practiced it over here also, so just select one or two good questions and wind it up, right? But do that, but do select the correct questions that covers all the areas right now, right? And what if you have done nothing till now? Then that's a separate question that will be discussed in the exam tip section right now in a few minutes. Okay, let's do this question and then move ahead. And remember, it is very difficult to learn the whole book with perfection, but obviously there will be some students who will learn it, and they would have learned the 80% till now. So they 80-90% till now, that they will make some further efforts to learn the rest. But first instance, make a strategy that you can at least get 60 marks in your exam. So if you try for 60, at least if you miss a few marks due to some reasons, you at least can get 50. So how to get those 60, what areas to cover, I'll tell you shortly. Okay, at least 60. Obviously you would some of you will go for even better marks. Okay, so the next question over here is 27. This is again on FRA. In this case, the rate which has been agreed on the FRA and the time of the borrowing is as follows. So the higher rate is 7.1. So this amount of guarantee has been given by the bank, and this is a question in which they want to borrow for 9 months. It's 9 months borrowing, 12 minus 3, and the loan is required in 3 months time, and there is a loan of 100 million. So now what happens? The rate remains at 6.5%. So now what will happen? Now what will happen in this case? That PNE will have to make a payment. How much will PNE have to pay? The difference between 7.1 and 6.5. In case the interest rate would have been higher than 7.1, in that case, the bank would have paid to the to PNE. In this case, PNE will have to make payment, and the payment amount will be this much. Let me calculate. The loan was of 100 million multiplied by 9 divided by 12. 9 months interest will be calculated 0.6%, and multiplied by this will equal $450,000. So 100 million into 9 months divided by 12 into 0.6% will have to be paid by PNE. So the correct answer is C. Okay, now 8. Using exchange rates based on interest rate parity, what is the dollar income received from the project? So they are telling you that using interest rate parity means you are going to enter into a forward rate agreement. So they are going to receive some dollars in foreign currency, some foreign currency amount, that is dollars, in the future. So you have to hedge it. So first calculate the forward rate and then divide the foreign currency amount by the forward rate in order to arrive at the local currency income. So you have to calculate the dollar income received. Dollar is the local currency. So you have to convert the foreign currency into the dollars using a forward rate. So forward contract is to be used, which is being indicated by the interest rate parity. So I'll be using the interest rate parity theorem to do this. So there are two timings of payments in this case. See, 200 million pesos will be received in 6 months time, and the total amount to be received is 580 million pesos. So the foreign currency over here is peso. This is going to be received, and we are talking about an income received. So what rate should be used? As there are receipts, higher rate should be used. PLRH, right? So RH. Now, the second payment out of 580, which is of 380, will be received in 12 months time. So two hedges are to be set. One hedge will be for 12 months and the second hedge is required for 6 months. Okay, so I will calculate two hedges. Okay, and secondly, they have given you the interest rate. So this is the local currency interest rate and this is the foreign currency interest rate, right? So, and the spot rate is also given. The current spot rate is 5. This is your spot rate, 5 per $1. So it's an indirect price of $1. $1 is the local currency. Okay, so let's move on to the solution now. I've given you the figures. I hope you have noted. So interest rate parity works on interest basis of foreign currency interest rate and local currency interest rates. So two rates I have to calculate, two forward rates. Okay, first, a 12-month forward rate and then a 6-month forward rate. The formula was spot rate 5 multiplied by the interest rate in the foreign currency, which is 10%. This is for a year, 12 months, and divide by 1 plus interest rate in the local currency, which was 6.5% to 1.065. This gives you a rate which is 5.1643. Then 5 multiplied by 1.05. Now I've divided the 10% with 2. So I get the 6 months rate and 1.0325. So this rate has also been converted into 6 months, 6.5 into 6 upon 12, 0.065 into 6 upon 12. So its forward rate becomes 5.0848. So now the income amount will be in dollars, the local currency will be, the first amount was of 200 million, which will be received in 6 months time. So for 6 months time, we'll be using 0848, 5.0848, plus the second amount will be received in 12 months time, and for that the forward rate will be 5.1643. So 380 divided by 5.1643. So this is how it works. So this makes the total amount to be 112.9 million. The correct answer to this is D. D is the correct answer. So first, using the interest rate parity theorem, I calculated the forward rate, and then I hedged it, converted into the local currency. Okay, now question 29. So in case of question 20, please go to the question 29. In respect of P&E company managing its interest rate risk, which of the following statements is correct? Smoothing is an interest rate risk hedging technique which involves managing a balance between fixed rate and floating rate debt. Yes, it's correct. Uh, by borrowing some amount at fixed rate and floating rate, you can smooth up the interest. You can reduce the fluctuations. And then assets and liability management can hedge interest rate by matching the maturity of assets and liabilities. So yes, this is also correct. If you have an asset for 4 years time, a receivable for 4 years time, so you will be receiving interest on it. And if the interest rate increase, you will earn a profit on it. You will receive more interest. But if you have a liability also against it, then you won't be earning profits, right? Because on the liability, if the interest increase, you will be incurring a loss, and the timing of both are same, so the rates will change with the same magnitude. So this is also a technique to hedge matching of assets and liabilities. So both are correct. The C is the correct answer. So see, in the what I have noted, that at some places they are asking about asking the knowledge of rules, that you should know the rule, that what's the correct rule. And at some places they are asking about the definitions, right? If you don't know the definition of smoothing, then obviously you can't answer correctly. Okay, the last point, 30. In relation to the use of derivatives by P&E company, which of the following statements is correct? How did I take 1.1 and 1.05? Actually, the foreign currency is peso, right? So the rate of foreign currency was 10%, right? So in the interest rate parity theorems, we multiplied the spot rate by 1 plus interest rate of the foreign currency. So it was 1.1, 1 plus rate of the foreign currency, which was 10%. It was divided by 100 to get into 0.1. Then the second payment was occurring in 6 months time, the 280 million payment. So as it was occurring in 6 months time, I have to take the rate for 6 months. So I divided 0.1 by 2 to arrive at 0.05. So it became 1.05. Likewise in the denominator as well, the local currency interests were taken 6.5% and then half of it. Is it okay, Cheyenne? Okay. Now moving on to the next section, the business valuation section. Okay, before going on to the business valuation section, I want to discuss the some of the techniques, some of the tips which help you in the exam and which will help you in studying during these days until your exam arrives. So what you have to do from today till the exam day. Now the study tips are on conditional basis. Obviously there will be some people who have studied to a great extent right now, and some people would have not much studied till now. They are still in process. Some people would have studied half of it, and some are just in the beginning phase, but still there is time. You can manage it, but if you have too many papers, you have to properly allocate the time between those papers. One very important thing is the planning is very important. Your planning for your papers is very important, that you plan your study properly. Like at the time when I used to study uh, myself, I used to do proper planning in these last at least 10 to 15 days. I used to write number of hours which I need to study against each chapter. So each chapter I knew in advance. I used to judge first that how complicated is that chapter and what are my weaknesses in each chapter and how much of the chapter I am weak at. So the chapters in which I used to be very weak, I used to allocate more time in that, right? And I was usually fond of studying for long hours. So I was capable of sometimes studying from 10 to 12 hours in a day. So obviously in 15 days I could have easily managed 180 hours. So in this much of time you can uh, at least study the things at least 2 times. So if you increase a bit of your study time, you can learn more. So do one thing, that first calculate that how much hours you have available with you. Suppose you have 70 hours of study time from now to the exam. Then break that time into the sections, that what sections need what time, like how much time you will invest in investment appraisal. So if you feel that you are good at investment appraisal, but you are not good at capital rationing in it, or you're not good at asset replacement decision or sensitivity analysis in it, so uh, base your time allocation on the basis of those sections. That suppose you decide and select two questions from two questions each from capital rationing, two good questions from the kit, two from sensitivity analysis, and two from asset replacement. So, or three questions from sensitive analysis, two from each of these, capital rationing and this. And you have plenty of material in my handouts as well now. Each handout has 7 to 8 questions. So you have got 40 questions over here also. And most of them are from the kit, or they or are from the past papers. Some might be from other places which you may not get, but you do have answers from them. So yeah, you can select questions and be selective, and instead of doing those questions one time, do it again and again. Do it at least 2 times so that you learn the process. So even you do not do it, if you're doing a constructive response question and you're making presentations and the whole of your working do not get correct, but 70% is correct, you will get 70% marks. And even if you make a mistake in the first step, but rest of your 90% working is correct, there is an own figure rule. Remember, own figure rule means that if first of your figure gets wrong, then the examiner will mark the rest of the question portion, the 90% of the steps coming afterwards, on your figure basis, your own figure basis. So if it is calculated correct and presented step by step, you will get the remaining marks. You will be just penalized for one mistake which you did in the beginning. So that's very important that you make the workings properly. So for constructive response question, try to do the typing work on the platform. And some people say that on remote based exam they are not comfortable with the scratch pad. So you can get comfortable with scratch pad. Get logged into the ACCA practice platform and open the scratch pad over there. And instead of writing on the registers right now, start writing on the platform. So you will enhance your speed over there. Now please be serious with yourself. Please don't do all your questions on your registers. Immediately start uh, linking to the and logging on to the platforms. Start using it. Start making workings on your worksheets over there, so that you know how to use the options over there, right? And you are very familiar with that platform. Obviously this platform is going to be used in your future exams also, right? So this is going to be helpful to you. And in the practical life, obviously the Excel sheet you are not going to use this one, but at least you get familiar with this one and you get a good speed in this. So in the practical time you will be getting benefit of it. Okay, so this was some tips regarding the planning work and using of the practice platform and the scratch card. And people who are facing calculating on the calculator over there and scratch card, they can get familiarity and uh, they can easily increase their speed over there and comfortable in that scratch pad and calculators if they at least work uh, some questions, some MCQ questions on those around 10 to 15 only. If you work over there, your hesitation will be removed. And believe me, it takes more time to write on the register rather than or on a paper rather than on those scratch pads and the word. But it just needs practice. Obviously you are writing since 15 years on the register. It is difficult to move from the register to the these word processing and the spreadsheets. I know it is difficult, and it will be difficult even for me. It was even difficult for me to write on these Excel sheets, but you know that now I have got habitual because I did start doing work on it since the beginning of the pandemic. Immediately when the pandemic started, we didn't have any options. The physical classes ended. I had to go on to the this, and I didn't have a board, so I have to use these processing sheets. I used to share these worksheets and these word processing sheets, and I started writing on that, and it started working as a whiteboard. So please start practicing on these things. And ACCA has given you an opportunity that they have made it available freely on the ACCA global website. So why don't you use it? Second tip, please, every one of you, go through the examiner comments section on your ACCA global. It's very important. You will learn a lot from there, that what mistakes did the past students did in their exams, question wise basis. So from there you will come to know in advance that what mistake you can make in the upcoming investment appraisal question or a capital rationing question. Like one of the comments that I gave you, that people usually do not study topics like capital rationing and sensitivity analysis or asset replacement decisions. So from where did I come to know this? This is the examiner comment, the marker who is doing this work. So as the ACCA is asking these questions, and people usually do the NPV and inflation and tax workings well, but not these items. So they observe from this and they have analyzed and they write over there. So I told you to do it. So now you would have started working on it. So due to my suggestion, you start, right? So from examiner comments, when you read it, you get an examiner suggestion directly. So obviously it can be very useful to you. Please go through it. Okay, now let me tell you about the sequence, how to attempt the sequence. What to do first? Should we attempt the objective type questions first, the section A, section B, or section C? What I would recommend, never to do section C first, because if you get engaged in section C and if you take too much time, because they are longer questions and you have to make presentations as well, and if you get God forbid you get involved in it and you take a long time over here, then it will get difficult for you to do the rest of the 30 questions, and you may get into a trouble and you may get into a stress if you have 32 questions to do and just 1 hour left or 1 hour and 15 minutes left. So it's always better to go through first the section A. Go through section A. Now, when going through section A, again, remember, I tell you again and again, go to the platform and check how to flag items, how to put flags on questions. So from there, you can learn that how to flag. So you have to learn to put on flags on the objective type questions, scenario based questions yourself by using the platform so that you get familiar. So if you feel that you are doubtful or you are not finding an appropriate answer, do not waste time on it. Immediately leave for the next question and flag that question which you have not yet attempted or you are unsure. Because if you put some more time in it, this can be very dangerous for the question to come in the end, which you may miss, and you know it very well. So that those 2 or 4 marks which you miss in the end due to the completion of the exam time, that can be very crucial for you and the difference between 48 and 52. So never invest unnecessary time in a question in which you are doubtful. Just flag it and move ahead. So what will happen that in 2 hours and 2 hours, around 2 hours or 2 hours 15 minutes time, you will be able to do all the questions that you know well, and the doubtful questions will remain flagged. The flagged question will remain unattempted. So now go through it in the half 45 minutes, in the last 45 or 30 minutes, and check that which questions you flagged and put in some guesses. Now, never to leave a MCQ question or a true or false questions unattempted. You must do it. You must do it. In case of blanks, obviously you don't know the answer, so it may get wrong. But in case of selection questions, in case of matching questions, in case of true false question, do attempt it. There is no negative market anywhere in the question, and in no exams of ACCA do an examiner negatively mark the student. So remember, always guess, place a guess. No one knows that if it goes correct and it makes you earn 2 marks, so you can get 48, you can get 50 instead of 48. So this can be a big bonus for you. So please do not miss anything. Okay. Now, one more thing. When doing constructive response, so first you'll be doing the objective type, flagging those questions which you are uncertain and moving ahead. Then you move on to the section B type question. Then you come on to the constructive response. Now, once you come on to the constructive response question, a tip over there also. Suppose in the end, you are left with 2 questions which are constructive response. One is calculation and one is theoretical. As I said earlier, I'm repeating this tip that do the theoretical part first. Do the theoretical part first, because if you do the theoretical part first, it will take less time to do it. So suppose it takes 5 minutes and you are left with 5 minutes. The calculation part will not take 5 minutes. It will take reading time only 5 minutes. So during reading only your time will end and you won't get anything. But doing a theoretical question, you can get more marks. So it's always handy to do the theoretical part first. And obviously without reading question, you can't work on a calculation question. But without reading a question, you can write a theoretical answer. It is not a good idea. Obviously without reading, you won't be able to write according to the scenario. Secondly, a very important thing, when you write a theoretical answer, you do not consider the scenario. You write the answer from your study text or your previously learned exam kit answer or examiner written answer. You must match your answer and discuss the matters that are being covered in the scenario. So examiner gets very much impressed when he sees that you talk about the stories and the situations which have been uh, given in the scenario. So if you use those scenarios in writing your answers, you get even better marks. Okay, now the topics that are important. See, I'm moving on to the 40 mark section, constructive response. Uh, Three topics are going to be examined: financing, working capital management, and investment decision in the constructive response questions. So 40 mark gets covered over there. So these three areas should be very strong of yours, very strong. If these three areas are very strong, and further business valuation and risk management, so you cover 60 marks of your exam easily. And cost of capital is also good, suppose around 70 marks you have covered. So by doing these 6 topics, obviously you will take less time. There are many other things to do in the in your book and your exam kit. First, cover these areas. First, pick some good questions which covers your syllabus in these areas, and do it again and again, at least twice from the exam kit. And then when you face problem in a exam kit question, refer to the book, the same topic in the book. So this makes easier to learn. When a question arises and you move on to the book, you will learn more in a more better way, and you will remember the things in a more sharp manner. See, the 3 topics are financing decisions, working capital management, and the investment decisions. These 3 are being examined in constructive response. So 40 marks covered there. Then in case study type questions, you will be asked about cost of capital and business valuation and risk management, for example. If it's just a guess, so these are the topics which you, if make yourself strong in, you have covered 70 marks, right? So if you study better on 70 marks and you make them strong, and then you work on the rest of the syllabus, so it will increase your chances of passing. So keep these topics very strong, and then rest of the 3 topics you will do some efforts on it to at least try to obtain half of the marks from there. Okay, now moving on to the study tips right now. So right now you have a lot of time, around more than 10 days. So what you need to do these handouts again. Select some good exam kit questions, 30 or 40 from each section. Sorry, 30 or 40 in total, but some questions from each of the sections, 4 to 5 questions or 6 questions from each section of your syllabus, which covers all the areas. Remember that all areas should be covered. So at least do two questions on each, like on factoring, like on policies of receivables, like on inventory management, like on this forward contracts, money market hedges, like two questions at least, that, and do it again and again 2 times, right? And the important thing I want to say, that when you start doing these questions, you will face that there are some tricky questions, very tricky ones, or moderate tricky ones. So start marking over there that these were tricky questions. Now this is planning for your last moment studies. So what happens that if you keep marking in colors or in highlighters that these were the tricky questions, right? Right now, what happens that on the last moment you can't study and revise everything. So these marked items will only be studied at that time, the tricky items. And the rest of the items already you know very well. So there is not much need to invest much time in it. So this is planning for the revision at the last moment. So when you are studying right now, please do mark the tricky questions and those areas in which you are not comfortable right now. So do invest more time right now also on it, and mark them out so that you can prepare put some time for preparation at the time of just 1 or 2 days before the exam, when you do a further revision at the time of around 24 or 48 hours before exam. So I think a lot of tips I have given regarding studying and attempting the questions and using the platforms. and various things. Let's take a 10-minute break and then work on the business valuations after this, and some more things to be discussed. I will discuss with when doing the business valuation question. So first of all, after the break, immediately 10 minutes time, I'll be discussing the fundamentals of the business valuation, which are very important, uh, on the basis of which you will get comfortable with the questions on this business valuation area. So I'll be doing some scenario type questions, case section B type questions on business valuations, and I have taken some constructive response questions on business valuation in this sheet, in the day 5 sheet, the answers of which I will provide you. But do practice those questions, because that will enhance your learning work. So they will not ask you a 20-mark question or constructive response question on business valuation, but those questions which I have pitched over there, I have taken over there, are selected in order to enhance your understanding of the business valuation topic. A business valuation topic is a bit tricky than other topics. It's difficult to decide about whether to invest in a share or a loan note or like thing, and it's very tricky in one sense. So it is important that you go through it. It's not a very long chapter. It is similar to cost of capital. Also, the formula will be very similar to those which we have done in the cost of capital area, but it is difficult to decide sometimes about the answers on questions. Okay, so students, take a 10-minute break. Let's meet after the 10-minute break. See you. Welcome back, participants. Let's commence with the business valuations area. Okay, let me give you a brief concept of the business valuation before I move on to this section and questions on it. See, what do we mean by business valuation? Now, you feel yourself as an investor, that you are an investor and you either want to buy shares in a limited company, or you want to buy a loan note or a convertible bond of a company. So what price will you be able to pay, or you will be ready to pay for a particular share? This is the question. That suppose you want a 2% holding in a company. Now 2% is a minority holding, right? So you have to buy from the stock market. So you do have a price over there and you will buy shares from there, but is it worthwhile buying it or not? So suppose the share is of $17. So should you buy it at $17? Now you have to make an evaluation that whether it is whether the buying is valuable or not. You should buy or not. But suppose this was a minority holding. Remember, just a 2%. You're not getting any control over it. But suppose you want to buy 60% holding. In this case, you want to obtain control over it. And if the share is of $17, you may be ready to pay some more than $17. You may be ready to pay at $20 as well. Now it depends that what benefit you are going to gain from it, and as you will acquire control over it, you will be able to restructure his operations and bring the operations according to your choice. And the calculations for that, how much price you will be able to pay, you will make those calculations according to your wishes, that how you will run the company. But if you are buying a 2% share, your calculation will be based on the current management strategy. Now, in both cases, whether it's a minority holding or a majority holding, a substantial more than 50% holding giving you control in shares, in both cases, the most important thing is income of that company. If the company's prospects are high, right? So everyone is basically after profits. If it gives you better profits in future, you will be giving up better price right now for the good profits. So it depends on the future prospects of the business. So what happens that you estimate the future cash flows from that company. Like in the 2% holding, you estimate that what the dividends are going to be. What is the growth rate of the dividend? So you will be using the dividend growth model to calculate the present value. So what is the dividend growth model? Basically, dividend growth model calculates the present value of the future dividends at a particular future growth rate. Sometimes we estimate the historic growth rate and apply it in the future, as you don't know the future growth rate. So we use the future dividends, which are the cash flows. Like in NPV, we calculate the present value, we calculate the present value of the dividends. So if the present value of the dividend is suppose $18 and the share is being sold at $17 in the market, the share is worthwhile. You will go for it. So this is the income method, the cash flow method. So the main technique in the business valuation is to estimate the future cash flows associated with the investment, whether it is shares or whether it is a loan or whether it is a convertible bond in which you are going to invest. If you are investing in a share, you will be estimating the future cash flows, like dividends will be the future cash receipts. If you are investing in loan notes, the interest will be the future cash receipts and the redemption amount will be the cash receipts. And if you are investing in a convertible bond, your cash receipts will be the interest and the redemption value, either cash or the share prices, if you get converted into the ordinary shares. So these will be the cash receipts, the present value of which you will be calculating. So this is the present value technique, the cash flow technique. Now, the second technique which can be used is to assess the potential of the investment, that how good the investment can be, is the price earning ratio. So what you do, that you multiply the earnings per share. Now I have discussed the cash flow technique for a 2% company and for the 60% company as well. In case of 60% company, you will not consider the growth rate of dividend with the current management is carrying out, because the management will change once you get a 60% control. You will judge your own dividends, that what the cash flow is going to be in the future, what the dividends are going to be in the future. The question will tell you that once you get control, what will be the dividends and what will be the growth rates, and they won't be same as what are going right now in the company, because the current management will be running the company in a different manner, and you yourself will be running in a different manner. So the cash flows will completely change. But that will be the difference in the minority holding and the majority holding. But you have to calculate the present values in both cases. Okay. So in the minority holding, you will be calculating the dividend growth rate, and majority holding, you will be using the present value technique of the dividends. If the dividends are equal, you can use the growth model, and the growth rate is equal, you can use the growth model. Otherwise, you can use the individual present value technique, which you have learned in the present and NPV calculations. So it will come in the questions. Okay, now suppose that you want to know the prospects of the company. Multiply the EPS with the price earning ratio, or divide the EPS with the price with the earning yield. It's the same thing. Whether you divide the EPS with the earning yield, or you multiply the EPS by the price earning ratio. Earnings yield is reverse of price earning ratio. Price earning ratio is market price divided by EPS, right? And earnings yield is uh, EPS divided by market price. So but they are just upside down. So EPS divided by earning yield, or EPS multiplied by price earning ratio, will give you the market value of the company that the company can maintain, because the price earning ratio will be of a good company in the industry, or the average price earning ratio of the industry it will be. So suppose the average price earning ratio of the industry is 10 and EPS is $2. So 10 multiplied by 2 makes the price of the share 20, but currently the share is being sold at $15. What do we mean? Buy the share at 15, buy a majority holding and restructure the operations. So buy the share at 15, restructure your operations. In a year's time, if you get it better, if you improve the company's price will increase, and it will increase to 20, because the price earning ratio 10 means of the industry means in the same sector means that the companies are capable of at least maintaining the price or earning ratio of 10, which you are not maintaining. With this company was not maintaining. So you bought it, you improved the operations, and then the price earning ratio rose to 20. So by buying the share in 15 and then selling in 1 year's time at 20 gives you a $5 gain within a short interval of time. So this can happen. So by using the price earning ratio, you can judge the potential that up to what price you can take the company to. Okay, so this is the price earning ratio method. Then there is another method. Again, these the cash flow method and the price earning ratio method, both are called income methods. These are known as income methods. The second branch is asset based methods. The asset based method means that we use the replacement cost. Now what do we mean by replacement cost? That if someone if an investor wants to make the same type of company from scratch, he wants to develop same type of company from scratch, so what price he will have to pay? So he will have to buy all the assets, the physical assets. Intangible assets are not part of replacement cost. So he will be buying all the tangible assets, and at the price that it will buy, at the cost that he will be buying the all the tangible assets is known as replacement cost. So this will be very huge. But suppose the company is not profitable, it's useless, which you are going to buy. Then the current investors will try to sell it at any price, because it is not making profits. So when the company is not making profits, then in that cases asset based methods are used, because if the company is earning a good income, the value of that company will definitely be more than fair value of the assets of the company. But if company is not working well, then the value of the assets goes down, and the assets are sold instead of the prospects of the company. So in that case, the company will be sold at the net realizable value, or the breakup value. So breakup value is basically the lowest price at which it's the price at which you can say that the current investors had to sell the assets because they are not being able to manage the company in a profitable condition. So that's why they have to sell it at that price, and this is no asset stripping. Okay. So now start doing the questions. I've given you a background of the asset valuation decisions. Let's start doing the question Loki. So please read the question. I'm giving you around 3 minutes time to read it. Then I'll be starting it. Okay. So let's start doing this question. Which of the following statements concerning the usefulness of asset-based methods? Remember what they're telling about asset-based methods. Now this means that the company is valuing another company using the asset-based method. Replacement cost, asset-based method of business valuation is correct. So replacement cost normally represents the minimum price that should be accepted for the sale of a business as a going concern. This is not correct. This is replacement cost is the maximum price at which the buyer is ready to buy, the investor is ready to buy. It's the maximum amount. This is he's talking about the seller. Replacement cost is the maximum amount which a buyer will be ready to buy. So this is not correct. Breakup value should provide a measure of maximum amount. It's not maximum, it's minimum that any purchaser should that any seller would be ready to sell at. So breakup value will be the minimum amount at which someone will sell their company, because they won't sell less than the uh, net realizable value of a company. So basically, no one will sell their assets below net realizable value. But if the company is earning a better income, everyone would sell their assets at a higher price than the net realizable value. Okay, so that in that case, income methods are used. Next, book value. So the A and B both are incorrect. Book value will normally be a meaningless figure as it will be based on historic cost. This is correct. Book values meaningless. Transactions occur on fair value basis. So this is the correct one, C. And D is also not correct, as it says asset-based methods give consideration to non-statement of financial intangible assets. So asset-based methods usually take into account in valuation of assets that are present on the balance sheet. They do not take into account those assets which are not on the balance sheets, right? And they also may not consider goodwill type of things, intangible assets. So this is also incorrect. These not correct. Asset-based methods do not consider these goodwill and all intangible assets and other assets which are not present on the balance sheet. But the income-based method do consider the goodwill and the income prospects and these type of things. Okay, now next point. Calculate the value of Loki PLC's equity to 2 decimal places. So over here in this case, what has happened that they have given you an ungeared beta. Ungeared means without any gearing, and you have to gear it. Like in the last class, we calculate the project specific cost of equity. This is of that type. So in this case, the debt to equity ratio is given for the gearing purposes, which is 1:2. We need the tax rate, which is 30%, and we need the beta, which is 1.2, and this is an equity beta. Equity beta means beta ungeared, so we have to gear it according to this company, Q company. So I will gear it using that formula which I gave you in the last class. So let's use these figures. So this becomes beta asset is 1.2 multiplied by the equity value Students, the formula is to be used for de-gearing the beta. The formula is as follows: value of E upon E plus D 1 minus T. Let me explain you this question. What has happened that the Loki company is fully equity financed. Listen to me carefully. The Loki company is fully equity financed. It is ungeared, right? And the Q company is the proxy company, which is geared. Now you need to calculate the cost of equity of Loki company, which is ungeared. So what you need to do, business risk of Q company, the proxy company and Loki company will be same, right? But the financial risk of Q companies, according to the gearing ratio given, which is 2:1, right? But the Loki company is ungeared, so you have to de-gear the beta, ungear it. So we need to know the BA from BE. This BE is basically a geared beta. Q company is geared. So if you read the question properly, now we are calculating the ungeared beta. So 1.2 multiplied by E, value of equity of Q companies 2, divided by 2 plus the value of debt, which is 1, to 0.7 after deduction of tax rate. And this gives you a beta of 0.89. So the value of beta decreases because of the elimination of the financial risk. Okay. So if a beta is to be calculated for Loki, which is ungeared, I have ungeared the beta of the proxy company. Now moving on to the requirement C. Calculate the issue price of Loki shares to nearest cent using the dividend growth model with a cost of equity of 14%. So cost of equity is 14%. which is represented by KE in this formula. And we have to put in the growth rate, which is 4% in this question. And dividend D1 plus G means next year's dividend. We need next year dividend. So if already they have given a next year dividend, then you don't need to put in the growth. But if they have given you the current year dividend, you have to multiply it by 1 plus growth rate so that you arrive at the next year's dividend. So D1 plus G means next year's dividend is required. K is cost of equity and G equals to growth. This is basically calculating the present value of dividends, which will arise in the future from the investee company to calculate the market value. This is a cash flow technique, cash flow, present value of cash flow calculating technique. Okay, let me calculate now and show you the growth rate in the question. So you can see dividend next year is going to be so this is next year's dividend, so no need to apply the growth rate, and the growth rate is 4%. Okay, so moving on to the solution. The same formula is used to calculate the cost of equity. If you shuffle the cost of equity towards left and bring the market value down, you will get the formula for the cost of equity, which we use in calculating the WACC. Okay, so 0.14 is the total dividend divided by 0.14 cost of equity minus 0.04 the growth rate. So this gives you 1.4 million. And the number of shares are 2 million. So divide 1.4 million by 2 million shares to arrive at 0.7, which is the price per share. And this 1.4 million is value of the whole company. The value of the whole company is also known as market capitalization. No, beta equity is a gate beta. Beta asset it should be. BA. BA stands for beta asset. BE is big equity beta. Equity beta is the gate beta. The Q company was proxy company, and they have given you the equity beta for proxy company at 2:1 ratio of debt to equity. The gearing ratio is 2:1. We have converted into BA, beta asset. Is it okay, Idrissa? Okay. Now, what is the market value of the redeemable bonds? Now, what should be the market value? I have discussed the market value calculation technique. So if you are buying a redeemable bond or a loan note or a convertible bond, what will you do? You will calculate the present value of cash flows associated with that bond, which is interest and the redemption value. So we will calculate the interest and the redemption value. So this bond is the redeemable bond is of 100 million and 5% is the interest. So what I will do, I will calculate present value of the interest to be received and present value of redemption value. This gives me the value of the bond. So in case of interest, the bond is of $100 usually, and multiplied by 5%, which is a coupon rate, gives you the interest. And this bond is for 4 years. So take an annuity fraction and the rate of return is 6%. Okay, let me make the chart like we make for calculating the present value. This will occur from 1 to 4, and present value of redemption value will, the cash flow will occur at year 4. So these are the timings. Then the cash flow amount will be, interest will be of 5. Why 5? 100, usually bond is assumed to be of 100 face value, and 5% is the rate which is given in the question. And the redemption amount is the face value. There, if the redemption amount is different, and if it bears a premium above the face value, they will mention in the question. So this amount is 100. Now multiply this by the present value fraction. So present value fraction, I'm taking annuity fraction over here because cash flows are equal. So present value will be calculated at 6%, which is the required rate of return. So this makes so there you go. You get the market value, which is 96.53. Using the cash flow method. Okay, now please read the question E. Which two of the following statements concerning 4T's perspective are true? Which two are true? Okay, in case of investment decisions, if the tax rate is not given in the question, we assume in a business valuation question, we assume that interest income is not taxable. That's why we do not uh, take taxes in the calculation. But in weighted average cost of capital, usually you would be given the tax rate. So in weighted average cost questions, we use the tax shield for the company. Over here, it may be that the buyer is not a company; it's an individual investor. So in business valuations, do not adjust for tax from the interest, but when you calculate the cost of capital, you have to account for the tax shield in the WACC. That's why you have to mandatorily adjust for the tax over there. Okay, now in this case, B is correct, that as convertible bond is lucrative and can give you more benefit in the form of conversion into shares than the cash redemption value, the company may issue the convertible preference shares at a lesser dividend compared to the normal preference shares. And secondly, the C is also correct. 4T are likely to prefer to use CAPM in valuing Loki shares. So the cost of equity should be calculated using cost of the CAPM rather than dividend growth model. And A and D are not correct according to the question, the story given in the question. So the correct answer is B and C. Now, question number 5. Please go to the question 5. Okay, why was B correct? B was correct because they are saying that the dividend in case of a convertible preference shares will be lower compared to the normal preference shares. So what happens that in a convertible preference shares, there is an option by the time of redemption that the investor can convert into the ordinary shares. And usually the price of the ordinary shares is higher than the cash redemption value. So he goes or exercise for the shares redemption. So he gets a better value. So if you are giving a better amount by the end of the life of the bond, you can reduce your dividends. So when you reduce your dividend, your cost reduce. Okay. Now one of the participant is asking that why is A correct? Why is A not correct? So A says that 4T's investment in the preference shares will have the lowest risk out of 3 methods of finance offered due to the option to convert. Ordinary shares will be more expensive. Na? How can preference shares be more expensive? The most expensive is ordinary shares because it is equity and it is most prone to the uh, fluctuation in profits due to the fluctuation in dividend and market prices due to the fluctuation in profits. Otherwise, the rate on the preference shares loan notes are fixed and they are predetermined. There is no fluctuation, so they are less risky. The most risky is equity, then the preference shares, then the loan notes. So it's not the least risky. Okay, now Pike Company. Okay, so students, based on assets value requirement A, based on assets value, what is the minimum amount Fred should accept for the equity of Minnow? What is the minimum amount that he should accept? So minimum amount, remember, will be asset based. Replacement cost will be very high. Replacement cost will be the purchase cost of making this company. So no one will sell at net book value of equity. This cannot be correct. This can be an answer. This can be an answer. And bank loan, obviously they can't sell at bank loan. So there is an answer between these two. What are asking? Minimum value. So minimum should be 11.2 million. This cannot be minimum because NRVs are, if a company is not performing well and they want to sell it, so the minimum amount will be net available value, and this is all obviously 15.3. So out of these two items, the minimum amount is 11.2. Replacement cost will be usually higher than NRVs. So the correct answer to this is 11.2 million. This is answer C. Now, requirement B, calculate the market value of Mino company using earnings. So what do we mean by earnings? They are asking to calculate on the basis of earnings per, price earning ratio. So the price market value of a company on the basis of price earning ratio is equal to EPS multiplied by the benchmark PE ratio. So over here, they have not given you market price per share. If they have not given you market price of share, then you can use net profit multiplied by benchmark price earning ratio. Benchmark price ratio, as I said earlier, will be of a good company or an average company in the industry, or it will be an average of the whole industry's price earning ratio. So this is to judge the potential of the company, that what shall be the price of a share, but in fact it is not. Okay. So in this case, let me refer to the things in the question. Please read this part, statement of profits. This is Mino company statement of profit. So this is an income based measure. The profit after tax was 7 million and it is expected to grow by 3%. So if you are predicting a price, you won't be using this price. You will be using 7 into 3%, which will be the next year's price, which is going to sustain in the future, because that's historic price, historic profits. So you're using a sustainable profit. Now, despite owning and running the company, Fred Mino does not take a salary, preferring to take money out of the business. So this profit is not correct because there was no salary of this person, right? So he used to take high dividends. Pike PLC estimate that it will need to offer a salary of 1,000. So once Mino is sold, they will have to pay salaries of 1 lakh, and on salaries they will have to pay tax as well. So they will be able to save some tax of 30%. So the net salary will be net, at one place the expenses will increase and the other place the tax expense will decrease. So the net expense will increase by 70,000. So the next year's profits are going to be increasing by 3% due to the growth. And secondly, the expense will increase by 70,000 due to the salary. So what will be the net profit? We're taking the profit for the next year in case of predicting the target company. So it is not EPS, it's not earnings per share or net profit. This is sustainable profits, that profit that will sustain in the future. So the historic net profit 7 million is not going to sustain in the future. So that will give you an incorrect price. So what I will do over here, I will take profit 7 million, multiply it by 1.03, so that I arrive at the profit which is going to be practical in the situation, and then deducting 1 lakh and the tax on it. So this is the profit amount now. And now calculating the market value. So multiply 7.207 multiplied by the benchmark price earning ratio. So 7.14 is the profit multiplied by the price earning ratio. Benchmark price earning ratio has been given over here in the question. This is 7. Trout Company, a quoted advertising agency with similar gearing and growth prospects. You may know company. So similar companies' price earning ratio in the market is 7. So either you'll be taking price earning ratio of the similar company or an average company or industry average. So 7.14 into 7, this gives you the market price, which is 49.98 or approximately 50 million. To nearest million, it is 50 million. No, business valuation can't be a section C question. It's going to be a section B or section A. It can be a 10-mark question in section B and object type questions in section A. But I have taken some section C questions or as well in this handout in order to make you learn some to build your understanding. I'll be giving answers to it. I will share answers to it. So, and you have to work on it so that you can obtain a complete view of various things. Because obviously in doing scenario based and objective type question, sometimes we are not able to get the complete view of the situation. So there are 3 questions constructive type in this handout, which you have to do it yourself as a homework, but you must do it. They are very important questions. Okay, one more thing I want to explain in this topic, business valuation, is efficiency of markets. So remember, there is a very important thing that people in the market, the investors in the market, what level of information they have. So if they have a very good level of information and they have obtained all the information which have been communicated by the company and which is present and is publicly present in the market. So if they have all information, the stock market, by market we mean the stock market, the stock exchange, the investors in the stock market, we mean market by them. So the investors in the stock market, if they are well informed regarding all the communications and all the information which is present in the market and has been published to them, publicly available. So the market is said to be semi-strong form. It's a semi-strong form market. And remember one thing, and you would have noticed, you have observed that I will take 5 or 10 minutes more after the ending time of this webinar. So sorry for that. Every day I give you a 10-minute break and then extend the 10-minute time afterwards. So please excuse me, but it's for your benefit. I'm working for you people, working for you to get information, right? So I'll be also communicating you afterwards on the group as well. Uh, I'll be indicating the important areas or important things, notes and formula, etc. on the group in the coming future. Okay, so but on the webinar, I have just got a few minutes more now, so I'll be completed it. So there is an important area, the efficiency of the market. So one of the magnitude is semi-strong form, means all publicly available information, all published information are possessed by the shareholders. So you would have observed that whenever the profits of a company are published or dividend is announced, the share prices go up. So why do this happen? When public come to know about a good news, they feel that we are going to get an advantage in the future, so the prices go up. It's just like an expectancy theory. Now there can also be a market where people or investors in the market are not well informed regarding all the published information. That's a weak form market. They're not informed about, and they are behaving on the previously available information. So the share prices in the stock market will not reflect the very recent information which has already been published in the market. So this is a weak form market, but people are not that efficient. But there can also be a market where people even know the confidential information which the board people know only. The confidential decisions which have been made in the board are usually not communicated to the public unless they materialize and they feel that should be communicated. Otherwise, there can be a big problem for the company. The company may struggle in that case. So if the market is in such a efficient level that they even know the board of directors decisions and the inside information, then the market is said to be uh, a strongly efficient market, a strong efficient market. Strong is said to be in the strong form. So there are three forms of the market: a weak form, strong form, and a semi-strong form. Usually we find a market in the semi-strong form, in which when things get published, then the market react and the prices of the shares are adjusted and the value of shares and the value of the business amend, it change. Okay, so please go through this area also. This is a very important area. Secondly, one more thing I want to tell you about the dividends, that what is the importance of dividend. So the dividends are very important, that the management of the company shall keep the dividend due smooth. If they keep it smooth and keep it a bit growing over the years, it's very helpful for the shareholders. They have certainty that in the future also a particular dividend will be paid. But if the management adjusts the dividend by much every year, sometimes they give a very high and sometimes very low dividend, the market prices of those companies do not behave well. Now there are two views in this case: the dividend relevance theory and the irrelevance theory. You have to go through it. This is very important area, dividend policy. So some people believe that it doesn't matter whatever the dividend is every year, because they are very well to do and they have a lot of cash to spend on, and they don't mind if they don't get a dividend every year or get a lower dividend in a year. They say that if the dividends are not given, the equity will be higher due to the higher retained earnings and the market prices will be higher. Obviously the market prices will be higher, so we'll be earning in the form of the capital gain, if not in the form of dividend. So otherwise they will earn the dividend and the company will grow because the profits will be reinvested in the business. But the other side is those people for whom the dividends are very relevant and they cannot live or they cannot survive without dividends. There are companies which depend on dividends to meet their administration and marketing expense. There are individuals whose only earnings are there, earnings for their living is dividend. So if they don't get dividend, they won't be able to survive. So if they invest in a company and they don't get a stable dividend, they won't purchase the shares. The prices of the shares goes down. Now one more view that I want to tell you, that there are several people in the stock market who do not understand what profit is, but they understand the dividend because they get cash. So they get happy when they get cash. Obviously, they don't know how to read the financial statement. So how they can make an understanding on the basis of financial statement and profit, that how the company is performing. So there are people who basically base the prices of shares on the basis of dividend only. This is the basis for judging the prices. Now, the people who understand, they should not base the judgment on dividends, because the company who gave a good dividend but they have not earned good profits, their prices should not be high. Let me repeat again. The company who pays high dividend current year, but they have not earned a good profit, they have paid out of the previous profits, out of the retained earning, their prices should not be high because they are performing poorly in profits. This is a view given by Modiglin and Miller, that Modiglin and Miller say the companies whose operations are good, their prices should be high rather than the companies who are giving a good dividend. So students, please go through this dividend policy chapter also. Okay, so one more question, student, we will attempt, and that's calculate the market value of the equity of Minnow company using discounted cash flow. So if we use a discounted cash flow technique, what will be the market price of the company? So according to the question, if we use a discounted cash flow technique, so you will find that they have given you a 6 million cash flow next year, and they have given you a WACC of 12%, right? And they have given you a growth rate of 4%, cash flow growth by 4%. So if you are to calculate the discounted cash flow like in NPV, how will you calculate? Now this is going to be an annuity, cash flow from next year, and per annum this will increase by 4%. So in this case, you can use the dividend growth model. This is something like dividend growth model, that the company will earn 6 million, which will grow by 4%. So D1 plus G divide by, but this is an perpetuity. Perpetuity means an indefinite time period. Dividends are also for an indefinite time period. So if they ask you for this method, the formula is, suppose it's indefinite and there is a growth rate. The formula of present value of a growing perpetuity is cash flow, annual cash flow, divided by WACC minus growth rate. This is the formula for calculating the present value. So annual cash flow is 6 million divided by 0.12 is the WACC minus 0.04. So as I said earlier, some people will find the price of a company, a value of a company, using that what cash will they be able to earn in the future from that company. So they discount the cash flow with the WACC. So 6 divided by if the perpetuity is not a growing perpetuity, now they have a loan as well. So considering the loan, they have a 2.5 million bank loan over here. So this is the value of the whole company. So considering the loan, 75 minus the 2.5 million loan, the value will be 72.5 million. So the correct answer is A. Okay. So students, that's all for the day 5. Now there is a plenty of practice material for this business valuation on this sheet 5, and you will get the answers uh, very shortly. And I hope the workshop being conducted, the webinar being conducted was useful. And I thank ACCA for giving us the opportunity for this learning in the very crucial time when exams are very close. And in this short time, 15, it was although 15 hours, but I think we did a plenty of practice in this session, and a lot of topics were being covered. Obviously, we can't cover all the 100% topics in these short sessions, but we have covered almost 70 to 75% of the syllabus areas, and have done a lot of practice. So thank you again to ACCA and participants, to you as well, for attending this workshop and working very hard with me. And and I wish you all the best, that you people get able to properly achieve your study targets, and you get able to study properly, do the exam quiz, do the past papers, and read the examiner articles, go through the platform, working platform, and get used to the the scratch pads, and the various options on the platforms, the flagging option and all, so that you can get comfortable in the exams. And I hope you will invest proper time so that you can earn better marks and perform well in the exams. So wish you all the best again, and see you somewhere in the future as well. Nice meeting you. Goodbye. Allah Hafiz. Assalamu alaikum. Okay, so I will be available on the WhatsApp group as well, but it's better that you ask me directly on my call, on my phone, on a WhatsApp message, probably a voice message, so that I can reply on it. It may take me some time because I will be taking some classes as well. I'll try to answer you rapidly in shortest possible time, right? Okay, welcome everybody. Welcome. It was a great time with you people. Nice questions were being asked, and I really like the questions, and the level of questions were good at this point of time. You were asking a lot of people have asked a very good level of questions. Yes. Okay, see you.